had an amazing day to the upside today. Looks like stocks have been able to rise quite significantly. All right,
Can you
so
also demonstrate how to actually place a trade in the Tradeovate? I
sure.
do paper trades, but it's not for Tradeovate.
Okay, sure. So let's go ahead and just do that then. Right. So what happens is, as far as getting into a trade on the Tradeovate platform,
Hmm.
there's two ways you could do that. You could still see my screen, correct?
I do.
All right, so there's two ways you could do that. You could either do that here on the left side or here on the right side, and I'll show you how to do both, okay?
Hmm.
So this left side is oh, excuse me. This left side is super down. And you should already have this template, by the way. This is how your Tradeovate is set up, correct?
It does come like that, yes.
Okay, perfect, great. So there's no need to then set it up. You would make sure you would have your the correct contracts labeled on both of them. Okay.
Okay.
Now this, as far as this side, this is what we call the active trader side. This is going to be real time quotes, right? So pretty much this is the auction that's happening in real time right now that we would see on the left side. I mean on the right side. Does that make sense?
Yes.
Great. Okay, so what happens is on this side we would be able to change our time frame. Okay, so typically when entering a trade, you potentially want to get into a trade while watching the 1 minute chart. Okay, now looking at the chart here, what you can do is a few things. You could either buy and sell at market, okay, or buy and sell at bid or the ask. Okay. Um, Typically, I would prefer that you would buy at the bid and sell at the ask, okay? And I'll explain why in a second. But um, before that, as you can see here, we have the 9 EMA, which is the dotted line,
Hmm.
and then we have the 50 EMA, which is the orange strike line, okay?
Okay.
You said you like the 9 EMA bounce, correct?
I do.
So this is a good example of a 9 EMA bounce, meaning it's going to bounce to the upside. So you either have it bouncing to the upside or downside, depending on um, the the market trajectory as far as what's potentially happening in the market that day. Okay, and so the 9 EMA bounce here would be once we came below the 9 EMA, but had not yet crossed below the 50. These are buying opportunities. So essentially, you would wait until it comes a little bit below the 9 EMA, but then your stop loss would be your 50 EMA, right? So 9 EMA bounce would be coming in on the trade, and I'm going to zoom in a bit here. Coming in on the trade, this is the 9 EMA. We broke below it in the same candle. So
Hmm.
what you would do is you would essentially wait until you see the next candle and wait to see if it now breaks below the 50 EMA on the 1 minute chart. Because we didn't see that, this candle would potentially be a candle that we enter into what, buys or sells? That's the
Bye.
question. Buy. Great. Now, why buy?
Uh, Expecting it to bounce back up.
Expecting it to bounce back up. I'm not giving you trick questions, Kimberly. I want to hear you say it so you can be accountable for what you're learning, right? Um, so I'm only asking you these questions so you can hear yourself say it. So we're coming down, and again, these are thoughts you're going to have when you're in the market,
Right.
right? What you want to ask yourself is the questions I'm asking you now. Why would I get in here? Why would I exit here? Those questions, when you're having that internal dialogue, that allows you to be steadfast in your ability to be profitable on that trade, right? Because if you don't have that internal dialogue for yourself, then you would essentially just watch the market happen, and then once things occur that are against what you think, right? So let's say you bought in right here, but then this candle ended up being red and then came all the way down. If you haven't asked yourself those questions yet, you're just, at this point in time, you're just going to be spectating, okay, you would essentially be stuck because you wouldn't necessarily know what to do or where to go. And the reason for that is because you haven't yet had that internal dialogue within yourself to say, hey, this isn't necessarily where I'm supposed to go, right? This isn't where the market is heading, and it's where I thought it was heading, right? And so when you have that internal dialogue, you tell yourself, all right, it crossed below the 9 EMA. The next candle, if it doesn't go even further lower, then I would enter into the trade. However, if the following candle then goes lower, then I would have to exit the trade. Okay.
Mm-hmm.
Do you agree with all that so far?
Correct. Yes.
Great. So let's say the red candle comes, this candle appears. What we would do is typically what I would do here is I would measure this candle and I would say, okay, if this is as low as we can go, I'm going to create a buy right at the low or right above the low, okay, of that red candle, right? And so I could simply just click on the chart and click buy. Now, while all the trading is happening, if it were to hit my target, which is now 58.28 based on this setup, right? I would then be initiated into that trade. That would be buying at that limit order, okay? So I would buy at this level. What would then happen is immediately after I bought at that level, I would then say, okay, well, I know it's not going to continue to go my way if the following candle ends up coming down maybe past the low of the previous candle or
Mm-hmm.
even touching the 50 EMA. Okay. And
Right.
that's where after I set the buy right here, I would then come here, click it again, and then hit the sell. What word do you see right here after it says sell one?
Stop.
Stop. And what does that stop mean?
Stop loss.
Stop loss. Thank you, Kimberly. That's exactly what that is. Now, envision a scenario where you get into that trade, you enter in at green, and then it comes down a bit, and you got stopped out. Right. The
Mm.
amount of money you're going to lose at that point in time is very insignificant. It's not a lot of money. Why? Because we set our stop very tightly, and it's based on the setup of the trade. Right. See, a lot of traders, what they end up doing, or what they're even taught and in other places, is that, hey, if you have a stop loss, make sure it's 10% of this or 20% of that. Kimberly, how much time do we have to calculate 10% and 20%? How much
Mm.
time do we have to calculate those things? If I were to tell you, all right, stop loss is 10% of this, you're going to have to go and do what? Grab a calculator,
Right.
right? You're going to have to calculate how many moves, how many ticks you'd have to go down before it's 10%, right?
Mm-hmm.
Well, through all that time spent, the market could have potentially already went inversely against you,
Right.
right? So the thought process or the thinking behind getting the stop loss based on the chart is basing things on human psychology. Because if we truly know it's supposed to go up to the upside, then I don't have to guess how much of a percentage before I know it's not going my direction. I just have to look at the chart. The chart's
Right.
going to tell me. Do you agree with that, Kimberly?
I do.
Excellent. Here's another one. 9 EMA bounce. We climb up, we come back down to the 9 EMA. What happens in the next candle? What happens in this candle? Once we got this low here, right? What happened in this next candle?
Um,
Did we go below the 9 EMA?
you did not.
I did not. Okay, great. So that since we bounced on it here, this is where we would enter the trade right here. Boom. Buy
Right.
one. You would just simply just click that level, Kimberly, right? Buy one at limit. Okay. Now, where are we setting our stop loss? If we enter in here, where on the chart should be our stop loss?
I would normally set it where there's a wick, but there are no wicks. So I'm gonna say the red candle, yeah, the
So
bottom.
if we entered into the trade on this candle,
Uh-huh.
I say buy right here. I'm in the trade. Boom. All right, great. Now, where do I set my stop based on the setup?
That one is tricky for me. So I would still make my stop loss below the EMA.
Below the EMA, so somewhere over here.
Yes,
Why is that tricky, Kimberly?
because my eyes aren't completely trained on some. Some of them are simpler to read.
Okay, let me help
Chart.
you.
Hmm.
Let me help you. You're absolutely 100% correct. Literally only being under the 90 MA is perfect. Because why? We bounced on it with this red candle, but
Right.
we never went below it.
Correct.
We bounced on it here, but we didn't go below it. Now it opened above the EMA. It kind of came down a bit, but it didn't go. It didn't go any lower than the previous candle, right? So if this is the candle that I'm entering the trade on, then my
Hmm.
stop loss is going to be right below the EMA.
Okay.
Why? Because we haven't yet broken the trend to go below it. That's why it's not tricky, Kimberly, right? Because do we see any red under this
No.
9 EMA?
Mm-mm.
So now it's not tricky anymore, is it? All the market would have to do is show you the inverse of what has already been happening. If Kimberly enters this trade and we're saying we're riding the trend up, all the market would have to do is show me what? That we are no longer part of the trend. If we're no longer a part of the trend, what would have to happen to show us that the trend is no longer?
It would have to break the EMA and touch the stop loss.
Thank you. That's why it's not tricky. You see what I'm saying?
Hmm.
So I don't. This is why I'm asking you these questions. I don't want you to psych yourself out. You already can see with your eyes what's happening on the chart. You just have to. You just have to believe in yourself to say, okay, this is the right decision that I'm making. Because once we come down on this 9 EMA, and then we end up getting into the trade, we don't we don't ever end up revisiting this area, literally, right?
Right.
So if we say, all right, we're going to set our stop loss here, I don't need my calculator at that point. So when that stop, great, stop. Now, if I'm in this trade and we start going up, okay, my stop loss is still below the 9 EMA,
Hmm.
right? If I'm looking to generate profits, what ends up happening, or what I would simply do is I would, since it would be set, there would be an X I would click right here. I would cancel the stop loss and then move the stop loss up. Okay. We get to this candle, right?
Right.
At this point in time, if we're up here, I don't have to keep my stop loss down here. I want to lock in profits. Cancel the stop loss, come back up here, set stop. This next candle comes. Kimberly, we're still not out the trade. Why? Why are we not out the trade?
Because it hasn't triggered the stop loss.
Because it hasn't triggered the stop loss. So we're going to continue to go up. We go up again. Okay. As we continue going up after this candle, all right, great. I'm setting my stop potentially right here, right? I'm seeing that we were able to kind of break through these wicks here. So once we get up here, I set my stop loss.
Hmm.
Do we end up getting triggered?
No,
No. Why?
it didn't touch the stop loss.
It didn't touch the stop loss. We go to the next one, and the next one, and the next one. And so literally, eventually, obviously it'll hit. At some point in time, you're gonna set it somewhere where the market will probably trigger it, but nowhere down here, correct?
Right.
So I love that you were able to identify the 9 EMA bounce because the setup, and this is where everything would start to make sense for you because the setup is going to give you not only where you should have your stop loss, but also where you should take profit. Okay, if we
Hmm.
if we if we came down on at this level up here, we wicked out up here, 58.35. If we wicked out up here, and then we came down, you waited, you were patient, and then you enter into the trade here. My profit target is between these 2 points, between the close and the high.
Right.
Okay. Now, with me knowing that I'm keeping the trend, I may want to potentially put the stop loss a little bit below. I mean, sorry, not stop loss, take profit a little bit below that so that I could give it some room to see if it could still go up. Because once this candle comes, now I'm really excited, right? Because
Mm-hmm.
I wouldn't have triggered my take profit. Okay. But still at the same time, you're continuing to move your stop loss up. Okay. Stop loss up, stop loss up. You're just monitoring the trade. The great thing about this side is literally if you have your stop loss, let's say your stop loss or your take profit is set right here, you can literally click it and then drag it. Okay. If it's already noticed, if it's already notified right here, because once you enter into the trade and you have your stop loss here, it's going to show. You can literally grab it and drag it. Okay. Literally grabbing it and dragging it. So even if you don't want to do a sell right here, right? You could literally just come here and then click where you had it at and then just drag it up to follow the profits. Does that make sense?
Yes, I've seen that Professor Josh do that
You've
on the
seen them do
vehicles.
that. Great.
So on here, on the
hmm
charting side, can you just drag the stop loss line, or you said I have to cancel it out?
So you would have to cancel it out.
Mm-hmm.
Now, here's kind of a ninja thing. And this will probably be something you'll do as you move forward in your trading journey. Um, what you can do is instead of canceling it, you could just set the stop. Like you could leave that stop there, but set the stop up here.
Okay.
Here's what you would have to make sure you do though. Once you do exit the trade, you would need to come back and cancel the stop.
Okay.
Because if you don't, then the market comes back down
Mm-hmm.
and you haven't canceled that transaction, that working order, what do you think is gonna happen?
It's gonna seek out that stop profit and I'll blow my account.
No, you wouldn't blow, you wouldn't blow your account, Kimberly. No. That's not what would happen. What would happen though is, all right, let's say we're in the trade. All right, we make so much money. We get up here, we take profit. Woo! We took profit. Great. We
Mhm.
make our money. Down here, this working order is still a working order.
Right.
Okay. So no money is being made or lost just yet. However, if the market starts to take a downturn and come back
Mhm.
down, I've seen new traders have this happen before. The market comes down and it boop and it hits this target that we had as our stop loss before.
Mhm.
That is now a new position. Okay. That means you have entered into the trade at that point. So even though we exited up here and the purpose for this was a stop loss, if
Right.
we've already exited and then we trigger this after we exit,
Right.
we have now started a new position and the new position would be to the downside because we selected sell. Does that make sense?
It does. That's tricky.
So here's what you need to do. After you've already taken profit, we have this nice big gray button for us.
Mm-hmm.
It says exit at market and cancel. That's what CXL means, cancel.
Okay.
So here's another thing you could do. Once we're up here, I mean, we could either decide to take profit from changing our take profit trigger, or we can just quickly hit this button. If we hit this button, we take our profit here and this cancels. Our stop loss down here cancels. That means pretty much we cancel out anything that's going on. We're either taking profit up here and at the same time we're canceling whatever working orders are out there. So we're basically like just completely starting from scratch with our chart. Okay.
Okay.
That's if you press this big nice gray button. Okay.
Mm-hmm.
So to recap that, we came down here, we enter into the trade, buy at limit. Great. We set our stop loss down here. Our stop is still here. We ride the trade all the way up here. Okay. We get up here. Let's say your stop loss is down here and then you just start seeing the market go crazy. This probably happened in a blink of an eye, right?
Mm-hmm.
So if that happens, you're like, all right, you know what? I'm good with this. If you just hit exit at market, you would take your profit here and then this line disappears.
Okay.
You got me?
Uh-huh.
Excellent. So that's how you would
Is it
trade.
possible for her to input the actual numbers? Because that's what we were working on our last session. Like if
So
she wanted to do 20 points or 50, like is it possible for her to type that in, or is it just based on?
so due to market volatility, at least when you're actually in a trade, I wouldn't suggest typing in the take profit as far as the amount of ticks. Now, it's possible for you to do, and the way you would do that is you would come to ATM settings here, and you would how you would do that is you would click here, and then you have different indications on what you would do. So you can have if you want to do 20 ticks, then you would type that in here, right? Take profit. All right, I'll take profit after 26, and then when I want to get out the trade, the amount of ticks I'm willing to risk, let's say 4, and then you save that. Okay, then once you get into the trade, that's what will essentially execute for you, right? So you do have that opportunity as well. Now, like I said, as a new trader, I probably wouldn't necessarily, um, I wouldn't recommend it per se, but that's essentially how you would go about that.
And then what is the amount of tick, or what is the take profit that she's striving for to pass this valuation specifically?
So the evaluation is calling for you to earn $1,500, right? So $1,500 would be over the course of 5 days minimum.
Mm-hmm.
1,500 divided by 5 is 300. If you were to generate $300 per day for 5 days, on that fifth day, you'll get an email from Take Profit Trader letting you know that they've transferred your account to becoming a pro account. Okay. After it becomes a pro account, you then have to generate an additional 1,500 in the markets. Okay. But then this time, this is real money. So anything above the next 1,500, you'll be able to withdraw from.
So that would be considered the buffer that
That would be considered the buffer, correct? So 1,500 to pass the challenge, 1,500 for the buffer, and then blue skies from there. Does that make sense?
yes. So while doing the eval, there is no buffer required. Once it's pro, it requires the buffer.
Correct.
Okay.
So if you were to, and then inversely, if you go under by 1,500, then you would just have to get another account. And that's where all of this works out, right? Because you could either lose a real 1,500, or with what we're doing, you could just lose $100. You see what I'm saying?
Mm-hmm.
When I first started trading, Kimberly, I was trading my real money. Okay, so if I was in the market and I lost $1,500, I lost $1,500. Right? If you were to be in the market with the prop firm account and you have that account blown, obviously all you would have to then do is just create another account, spend your $100, and keep it moving. Right?
Mm-hmm.
So why we love this is because once you do get that first payout, it would not only put you back into green, but it'll actually even have you at infinite returns at that point, right? Because let's say let's say you buy 3 accounts. 3 times 100 is 300, right?
Mm-hmm.
If once you were to get over into the pro account, and let's say on a specific day like today, the market's up 174 points. That's 3%. This is actually the most I've seen the market go up all year in a day, right? So imagine, let's say you had an account and you were going to the upside on that account. Essentially, literally in one day, you can generate all of your funds back and then some,
Mm-hmm.
right? So that's where the prop firm really works out. And then on top of that, this is an experience that can't be taken away from you, because at that point in time, you have the understanding intrinsically that with whatever potentially could be going on, you have the ability to make money with money, right? And so once you are able to pass the evaluation, like I said, it's essentially blue skies from there. And that's something that you can do. And that's something you can do very, very quickly, right? Even if it doesn't take you 5 days, it could take you 10 days, right? Even if it does take 10 days to pass the account, it's very doable. You have, even with just that one setup that we just went over, right? The 9 EMA that you like, even with that, just that one setup, if you look for that one setup and you trade that one setup, you can generate profits in the market without having to learn all the other setups that we have, right? Now, the reason why we teach all of them is because that's what we see. Now, for some students, they like the H pattern. They can see the H pattern very clearly, right? What does that allow them to do? That allows them to have confidence in the market. If I can confidently look at the chart and dissect what I'm seeing, then there's no guesswork. Then I don't have to be anxious. Then I don't have to worry, right? If we're riding this 9 EMA trend to the upside, all you're telling yourself is the moment I see red come near the 9 EMA, I'm in attack mode, right? Let's count it out. We already went through it. We already did this one. We did this one. That's 2, right? This one wouldn't really count as a touch, but we'll just say 2 for now, right? What happened here? Same thing here, right?
Yes.
9 may bounce. That's 4. How
Mm-hmm.
about this? How about this one?
5, right?
That's 5. This one we can count this one. How about this one?
6.
6. Okay, 6 opportunities. Now this is the 1 minute chart. We have 6 opportunities potentially in the same 30 minutes time frame. Let's count it. So we have this time right here is 12:30, okay? And up here is 1:05. So 35, we had 6 opportunities within 35 minutes. All the same outcome, Kimberly. All because of one setup.
Mm-hmm.
So I want you to conceptualize that, right? Like you have one setup that you know. Like that's you were born today and that's all you know. All you know is the 9 EMA setup, the 9 EMA bounce. We had 6 opportunities in the span of 35 minutes, not only to profit, but to potentially profit bountifully. Because if we get in here and we get out at the next 9 EMA, right, with one contract, and we could even calculate it here, with one contract from pretty much 58.30 to 58.35, that's 4 times 5, that's 20 points. Okay, and 20 points times 12 is, what's 20 times 12?
240.
240. Okay, so with one contract, we had almost $300 in profit. Now, what's 240 times 3?
720.
720. That would be nearly $750 in one move, which would be 8 minutes. So if we were to maximize the amount of contracts we had, that would be $720 we would have made in 8 minutes, right?
Right.
So on and so forth. Same thing over here. I mean, imagine we catch the end on this wick instead of over here still, right? Catching all this movement up here from down here, right? Same idea. We'll probably triple our profits going from here to here versus here to here, right? That would look like $2,000, right? From here, from 32 to pretty much 50. So from 30 to 50, that would essentially be $2,000 off of those three contracts. So that's essentially the idea, the name of the game. Now all we need is 300.
Right.
So let's imagine on this trade we only get 100, but we have 6 opportunities, right? So 3 out of the 6 opportunities, if we generated $100 profit, that's our day, right? If you have a $300 a day profit target, right, for how much money you would want to generate in the markets, this is only for the evaluation account, by the way.
Right.
Right? To get that $1,500 to enter into the eval account and then to create the buffer. After you've done that, you can essentially make as much money as you potentially would want to on that specific on that given trading day. Okay. Does that make sense?
It does.
Now we talked about the non-EMA bounce, and we talked about the change in trend of the which EMA is this, Kimberly?
That's the 50.
That's the 50. Amazing. So we have our non-EMA bounce and we have the 50. We know that there's a change in trend if we are to go below which EMA?
Below the 50.
Below the 50. Have we gone below the 50?
No,
We have not. This is another setup. If we can do a non-EMA bounce, why wouldn't we then be able to do a 50 bounce?
you can.
What happened every time we touched the 50?
There was resistance. It didn't break through.
It didn't break through, right? We had our support there. So here's a time where we touched the 50.
Mm-hmm.
We almost touched it over here. We touched it here. We touched it here. Okay. All those times, did it go up or down after it touches? After it touched,
Back up.
it went back up. If we're looking at all this empty space below this 50 EMA, do we see even any wicks below it?
Mm, right down there in the bottom left corner.
Over here, right?
Yeah.
But after we've created this double bottom over here, have we seen any wicks under the 50 EMA?
No.
Which would mean the trend is our friend at that point, correct?
Right. Follow the trend.
Follow the trend. So if the trend says 50 EMA is a support, if we touch the 50 EMA, right, then
Right.
we're able to identify that, okay, where would be our stop?
It would be below the
It
50.
would be below the 50 EMA. Thank you. So then again, there's no calculation involved. Now, what I like to do, here's a quick tip for you, okay? And I want you to really internalize this, Kimberly. The best way to maximize gains in the market
Mhm.
is to think inversely when you're entering a trade. And what I mean by that is this. If the trend is supposed to be going up, right? And we enter into a place where we start to see a support. How does it get to the support? What color candle does it have to do to get to the support? What color
Oh,
candle
it would have to be
what color candle is used to travel to the support?
red.
Red. I'm not trying to trick you, I promise, Kimberly. I'm really not I'm not trying to suck you out. I just want you to understand. The way to travel to the support is what color?
It's red. Bearish. Yeah.
The way for the support to bounce would be what color?
Bounce would be green.
Thank you. So, what does that tell us? What that tells us is if we see a red candle, Kimberly, we would potentially want to enter in on that red candle. Why?
It's going down.
It's going down, but for how long?
Oh, because you're looking for it to bounce back. So I'm thinking inversely, right?
Correct. Right? You know it's supposed to. So relative to any markets, right? Like even the real estate market in 2020, the idea was that the homes were coming down. I think a little bit before 2020, the home prices were particularly a bit lower, right? And so your thinking potentially is, okay, if I buy it now,
Mm-hmm.
then in a couple years, when the market starts to stabilize, what's going to happen?
Down
This
high.
is going to start happening, right? It's going to start going up, right? So what does that mean? That would mean then, see, some traders, they want to see the evidence. They want to say, oh, it's going up because I see it's going up. That's where the thinking inversely comes into play. If it's coming down in your head, you're telling yourself, oh, it can only go down but so much,
Right.
right? It can only go down but so much. I always liken this to the analogy of like a school bully, right? I was bullied in school. I'm not gonna lie, Kim. I was bullied in school. I wasn't the bully. But there was one day when the school bully came up to me, right, and he approached me and he knocked me down. I'm not gonna lie, he knocked me down. I was really brittle when I was younger. Okay. So I was knocked down here, but then I got back up, I let him go, right? But then he came back and then he tried to knock me down again.
Mm-hmm.
But I already knew how much force he had, so I was able to brace myself. I didn't go as low. So I was able to then bounce back up, okay? And then I knocked him out. Okay.
Right.
And so this is what that knockout looks like. This is that knockout punch. Now, again, if you're looking at the market inversely and we're seeing that this is a red candle, this would have potentially been a red candle before it became a doji candle. Okay. But if we're seeing the market correctly and we're saying it's supposed to bounce on this level, your confidence is not in seeing the green. Your confidence is seeing the resistance or seeing the
Right.
support. See, new traders, they would watch this happen and then watch this candle and then get in on this candle. But you already missed the opportunity.
Right.
The opportunity was when you were able to buy low, right? So, all in all, it's about identifying opportunity. It's like this red candle is like seeing an abandoned house, but you have intel that they're going to be building a brand new mall right across the street. Well, when people drive by, all they see is that abandoned building. But what they don't see is the support, right? You already know that the city is going to come in and build a mall there. Nobody else knows that, right? New traders don't really know the importance of the 50 EMA. This 50 EMA is that support. This 50 EMA for this analogy is you having that intel. Are you following me?
Got it.
You got the intel that the city's coming in to to provide a new mall. So you say, look, while everybody is afraid, right? That's when you start to get in. And again, this is across the board. This is across all the market in general. Okay. For instance, and I know we're about to end here in a few minutes, so I'm going to go over this very, very quickly. For instance, we have Tesla. We had everyone talking about how the market was going to crash, get your money out the market, X, Y, and Z. So we had Tesla coming down, right?
Mm-hmm.
I had the understanding that Tesla cannot be taken down but for so much longer. Okay.
Right.
250 was pretty much where I said I believe Tesla is going to start to rise again. Now, it did go a little bit below 250, but today Tesla is above 300. Okay. Tesla is above 300 right now. Tesla was about 220 just a month ago. So Tesla increased in price about 100 points. Okay. So when people are afraid, that's typically the best time, especially the general public, because they're going
Right.
to feed the public whatever they want to feed them to grab all their money. So what happens is they told everyone that the market is crashing. Oh my gosh, we're all scared. Everybody took all their money out. All the savvy investors, what did they do? They saw that red candle and they told themselves, this is where I enter. Everyone's getting out. This is where I get in. I understand where the support is at. So I'm going to get into the trade and play the long game. And that's essentially the thought process behind buying the dip is what they call it, right? But for us, we're talking about the idea of on a day by day basis, making sure that we hold true to the strategy, which right here would be the 9 EMA or the 50 EMA, right? So,
Can you
let's,
briefly touch on the buy market and the buy bid? What's the difference with
yes,
Solana?
sure. So it's very simple. Buying market means whatever the price currently is at the
Uh-huh.
market, that's where you're going to be getting in at. So whatever the market is dictating the prices at that time, that's what
Mm-hmm.
buy market. Buy bid. Bid is what the bidders are buying at. So there's a difference in price by about one tick. So when
Okay.
you hit buy bid, You're joining the bidders. You're saying I want it to be less than what the market is currently at right now.
Okay.
Now, sell market, sell ask, the inverse. Sell market is at market price. Sell ask is the people that are selling, they're saying, hey, I want a little bit more than what the current market price is. So I'm going to sit here on the ask side. And that's pretty much the war between bidders and, between the buy and the ask, right? So when you hit sell ask, you're putting your sell one tick above where the current market is. What just
Okay.
happened here, Kimberly, in real time?
It just bounced off of the 50.
What color is the candle that it bounced off of?
Green.
Well, what color before the green?
The red.
Red.
Mhm.
So if we entered on the red candle while it looks like things are not where they're supposed to be,
Right.
what happens immediately after?
It bounces back up.
It bounced back up. Now, again, as a trader, we're not looking or focused on only one side of the house, which is why we have take profit and stop loss. So if we got in on this candle, what we would have told ourselves is that we would be getting out of that trade a little bit below the 50 EMA, correct?
Yes.
Because why? That would identify a change in.
Trend.
Excellent. That's all it is there. So let's clap it up for ourselves. You have to always congratulate yourself when you learn something new, Kimberly. Okay, so that's what the clapping is for. uh, but how was this session for you? We just spent the hour going over the charts. How does it feel?
It feels great walking through it because it's super simple. Now, when I'm by myself doing it, it becomes a little bit more surreal.
Right.
I just have to
However,
work on building my confidence by practicing more.
correct. And a part of that is the internal dialogue, right?
Correct.
That's why I'm asking you these questions. I want you to hear yourself say it so you can assume, or the word is not assume, sorry. I want you to be saying these things so that you can be able to be confident in your ability to execute, right? Because you're the one saying it. You're able to then have your subconscious speak to you, even when I'm not there.
Right on. This is YC from the Option Snipers, and we're looking for new traders that are literally telling themselves, I have no idea what I'm doing in the market. If that sounds like you, it is going to be imperative for you to go ahead, click the link below so that you can join our community. Listen, we're not for everybody. So if you feel like you already know it all, please, by all means, continue to strive for your own success. But if you're someone that literally needs the assistance, it's definitely going to benefit you to join our community. All right, so go ahead and click the link below and we'll see you soon. Chat later.